This conference will now be recorded.
So this is a very motivational speech. It is in Hindi with a little bit mix of English. Just try to listen, you'll be able to understand. Attitude is everything.
कि यहाँ ज्यादातर युवागण बैठा हुआ है और युवाओं में एक सपना होता है, जिंदगी में कुछ बड़ी बात हासिल करने की एक तमन्ना मन में होती है और होनी भी चाहिए. That is a human dignity. That is a human endeavor. तो ये बात का विषय ये है कि हमें जीवन में समृद्धता चाहिए. हर तरीके से जीवन में प्रगति चाहिए और सब प्रगति, when all progresses they come together, they become success. सिद्धि भी चाहिए. कई सालों पहले होगी बात, 30-40 साल पुरानी, 30-40 साल पुरानी बात ये है कि थोड़े विचारक इकट्ठे हुए और उन्होंने कुछ ये सोचा, इतिहास के पन्ने देखते देखते कुछ बहुत सफल लोगों के जीवन चरित्र पढ़ते पढ़ते कि कहीं प्रसंग ऐसे बने कैसे सफल व्यक्तियों के जीवन में कभी ऐसी बात थी कि उनके पास रिसोर्सेस अच्छे थे, प्लेटफॉर्म्स, बैकग्राउंड, सपोर्ट सिस्टम्स सब अच्छे थे, लेकिन कम सफल हुए या सफल नहीं हुए या बुरी तरह से भी उन्होंने जीवन में निष्फलता देखी. और दूसरी तरफ गौर करते हुए कुछ ऐसी भी बातें उन्होंने पाई इतिहास के पन्नों में से कि रिसोर्सेस कम थे, मतलब पढ़ाई भी थोड़ी कम थी, कुछ फैमिली सपोर्ट कम था, कुछ फाइनेंशियल बैकग्राउंड ठीक नहीं था, समाज में से भी सपोर्ट सिस्टम्स, प्लेटफॉर्म्स कम मिल रहे थे. इस परिस्थिति में भी इन लोगों ने जीवन में बड़ी सफलता पाई. तो ये सब विचारक विदा में आ गए कि कई बार रिसोर्सेस बड़े अच्छे हैं फिर भी योग्य सफलता नहीं मिली, कम मिली या निष्फलता मिली, और कई बार रिसोर्सेस कम थे तो भी ज्यादा सफलता मिली. तो मतलब रिसोर्सेस के अलावा कोई और भी कारण है जिसकी वजह से एक बड़ी इंपैक्ट जीवन में, either on the side of success or on the side of failure, it is seen, it is observed, it is experienced. 10-12 साल तक गौर करते करते ये सब विचारक पश्चिम की भूमि में एक निश्चित विचार पे आए कि whether you have lesser resources in life or more resources in life to attain all kinds of progress and thus success in life, उसकी गिनती थोड़ी कम है, लेकिन उससे ज्यादा गिनती है आपके जीवन के विचार, आपके जीवन का अभिगम. आप कोई भी परिस्थिति में, कोई भी संजोग में किसी भी व्यक्ति के साथ कोई कार्य करते करते, कोई संबंध रखते रखते किस प्रकार के विचार रखते हो, इन परिस्थितियों में किस प्रकार का अभिगम आप रखते हो, that counts more in your success than resources. एक बात तय हुई, एक बहुत बड़ी बात तय हुई मनुष्य जीवन के लिए कि आपके पास जो रिसोर्सेज है, धन है, वैभव है, सत्ता है, बैकग्राउंड है, प्लेटफॉर्म है, उससे भी ज्यादा कोई एक फैक्टर जो काम करता है आपके जीवन में बड़ी सफलता के लिए, तो वो है आपके विचार और आपके अभिगम. तो ये विचार करते करते एक बहुत बड़े विचारक, अमेरिका के बहुत बड़े थिंकर, मैनेजमेंट गुरु जेफ केलर ने एक पुस्तक लिखा और इस पुस्तक में यही बात उन्होंने बड़े विश्वास से पूरे संशोधन के साथ अच्छे शब्दों में उन्होंने पेश की और ये पुस्तक का शीर्षक उन्होंने लिखा एटीट्यूड इज एवरीथिंग। मतलब जीवन में जो कुछ भी है वो आपके विचार अभिगम है। इस पुस्तक में जेफ केलर ने लिखा, I would suggest all of you to read this book, and especially the youngsters who are into family businesses or they are professionals. Attitude is everything. जो कुछ भी है वो अभिगम है। इस पुस्तक में वे लिखते हैं कि सक्सेस बिगिंस इन द हेड, सो थिंक राइट। विचार आप सही प्रकार के करें। दूसरे विभाग में ये पुस्तक में ये लेखक लिखते हैं, योर वर्ड्स डिसाइड योर पर्सनैलिटी एंड कैरेक्टर। आपके जो शब्द है जो आप बोलते हैं वो आपका चरित्र और आपका व्यक्तित्व दोनों का निर्माण करता है। सो स्पीक वाइज। तीसरे विभाग में ये मतलब अंतिम विभाग में ये पुस्तक में जेफ केलर लिखते हैं, your actions actually produce results, so act purposefully। आप हेतु समर बर्तन रखें। So think right, speak well, and you act with purpose।
Welcome, friends. Very important words. Attitude is everything. If you plan with an attitude, no one in the world can stop you. Right? So time for some revision. How many of you have revised? Never give up. Today is hard. Tomorrow will be worse. Day after tomorrow there will be sunshine. So there are two types of option strategy, directional and non-directional. So the first one, when you know the direction of the markets, bull, call, spread, +1, -1. What are you doing? You're buying a call with a higher premium, +1. You're selling a call, lower premium, -1. Same quantity, same expiry, same underlying. So two strategies combined together, bull, call, spread. So when you are bullish in the underlying. So you remember I taught you a bullish formula. What is a bull zone formula? Do you remember that? Anyone? Did I teach you that? 52-week high. What is the formula? -480R. Thank you so much, sir. Lovely. 52-week high -480R. So in Nifty right now 15945, 150, 15345. Till it does not close below this level for 2 days, underlying Nifty is bullish. So there might be small corrections, but that does not mean that the overall trend in the long term has changed. So basically there might be correction down the line. So this is 15,950, which is the recent high today, yesterday. So 15,345. So this is your bullish zone. So now you have to find in this zone, if the underlying sustains, you have to find high probability entries, right? So in technical, there is a saying, technical analysis. The number of points or the number of confirmatory signals, the higher it is, there is a more probability of it succeeding. So there is a word called confluence of various points. So when there is an influence or a confluence where all the points are meeting, those areas you get a very successful and a powerful trade, be it candlesticks, be it indicators, be it moving average, be it support and resistance. When you mix all of them and most of them agree at a point. That is where the technical analyst succeeds. Am I making sense? So I have taught you this. This is called a bullish support line. So when I'm doing a bull call spread, I'm looking at the option chain and I'm trying to find those areas where the underlying might either enter a range or a profit booking zone. So I'm looking at that leg where there is an expected profit booking. So let me have a look at the Nifty chart. It's there. This is a Nifty chart. Now, can you tell me what is your outlook as per technicals? What is your outlook? Good, yes, sir. Okay. Vikesh sir, yes, sir, Anand sir, and all other people. Please understand one thing. Listen carefully now. There is something called a time rule in a breakout. There are two rules. One is a price action rule and a time rule. Okay. So just see this breakout. This was your first point. A good sell-off came in. Second time, it retested that high and a sell-off came in. Third time, it came down, but there was a bounce. Now, can you tell me what is the differentiation here? Can you tell me what is the differentiation here? See very carefully. Okay. Can you see this candle? After a breakout, when the high is not touching the breakout level, after the breakout, when the high is not touching the breakout level, that means that particular breakout is a failure. Chances are high. See here, this candle. See here, this candle. But if you see here, it is touching. Even in a correction, it went up and it touched. So moment it went up, it gave you money. So sir, am I making sense? See this. It is making new highs. Again, it failed. Again, see this candle. So now you are at a very critical juncture. If tomorrow there is a gap down and if it does not touch this level of 15,915, then probably this breakout will again fail. On the other hand, if it survives for another one day and it gives upside breakout, it will be a correct breakout. So generally after a breakout, the next 2 days are very critical. Next 2 days. Because this is called, you remember I told you first technical class, shades of gray, shades of black and white. See, what is happening, Vikesh bhai, Sukhbir sir, you all are thinking in terms of black and white. ऐसे नहीं तो ऐसे होगा. No, if this, if not that, that's not maths. Here there is a fight going on. So you have to think in shades of gray. You have to think both from the eyes of the buyer and the seller. Am I now making sense? This is a very critical zone. Make or break zone. Either it can come here or it can go here. But it will not be cleared very soon. It might take Tuesday for the clarity to come in. Good. Avinash sir, am I making sense? So don't see everything like a movie. Think like a director, right? Think like a director. So is it clear? So if tomorrow, if you see there is going to be a gap down, and this line is at 15906, and there is a gap down opening, and it does not touch 15906, then you are in a problem. Then again, this type of range will happen. You might go down for 3-4 days, again come back up, and that range trading continues. Right? So this is just to shake out the weak hands. Those people who are short in the market, they have been taken out. Right? But yeah, tomorrow if it sustains, on Monday if it sustains this level, and again if it breaks out of this level, this is going to be a powerful breakout. Then you might see this type of a rally. This type of a rally, 3-4 days, 5 days. Good. So I hope I'm clearing your doubts when to take a bull call spread. Right? So how do you do the spread? Like this. You're buying a call, you're selling a call of a different strike. So this is strike A, this is strike B. So when you combine this, what do you get? This was strike A, and this is strike B. So the actual curve will be the dark line, and the dotted line is the combination. So this unlimited profit of strike A and unlimited loss of strike B gets neutralized. Limited loss, limited profit strategy. Is this clear to everyone? Any questions, any doubts? Good. Bull put spread. Two-legged strategy. You are bullish in the market, but instead of the call, you're using as a put. Right? The difference between the bull call spread and a bull put spread is we have a net debit in a bull call spread. The market players need to pay for the net difference in premium between the two spreads, which is in a bull call spread. While in a bull put spread, we receive the credit, right? So you are selling a put of a higher premium. You are buying a put of a lower premium. Same underline, same expiry, same number of options. So can you see this? We have done this exercise. Same strike we had taken, 16,000, 16,200, right? So we had sold the 16,200 put, 296. We had bought the 16,000 put, right? So we receive a credit of 133. So if I'm doing the same strike in a bull call spread and the same strike in a bull put spread, what am I seeing? My payoffs are the same. My Greeks will be the same. Technically, it should be the same. There might be a minor difference of 1 or 2 rupees, but technically it should be the same. Am I making sense? So can you see that the PL will be the similar to that of a bull call spread? So my friends, the next question comes in. If I am trading the same expiry, bull call spread and the bull put spread is the same. I have told you that you have to take a bull call spread. The margin is less. The liquidity is better in a bull call spread than in a bull put spread. So how do I solve this? When will I do a bull put spread? Thank you, Sukhbir sir. you have really done your revision. You have really done your revision. When the premiums are on the higher side, we define the higher premium as when IVP is greater than 65. Right? So when IVP is greater than 65, what are we doing? We are finding out the support. If this case, the support is at 15,500. So we are selling out of money put and we are buying far out of the money put. So in this example, 150 we sold, 65 we paid. So the net premium was 85 rupees. Right? Is this making sense? Good. 15,200, 15,300, 15,400. These are your payoff. So what is the support? 15,500. So what do you see? Below 15,500, you are going to have losses. Up to 15,200, maximum losses 300 points. So what are we doing? With a strict loss of 15,500 around individual levels, we are squaring off the position. Strict stop loss. Strict stop loss. Am I making sense? Is this clear? Any questions? So let us see the cheat sheet. Bull call spread, delta, positive. So any directional strategy, the Greeks will be in a bullish, the delta will be positive. Theta will be negative. Gamma positive, vega positive. So any movement, any event, a bull call spread will be profitable. Any movement, bull call spread will be profitable. The next one, bull put spread. Delta positive, theta positive, gamma negative, vega negative. This is for the bull put spread when we are selling out of money puts, buying far out of the money puts. Not the normal one. This is when IVP is greater than 65. Am I making sense? Now the third one, which is bull call ratio back spread. So one is extremely bullish and one is expecting quick movement in the bullish direction. So to implement the ratio call back spread, I'm selling at the money call or higher premium leg one. I'm buying two at the money or out of the money calls. Am I making sense? All strikes belong to the same underlying, same expiry. The calls. Okay, so Ramakrishna sir, I'll just come to when to implement the strategy. The call of leg 2 should be double than that of leg 1, right? Unlimited profit if the market goes up. Limited profit if the market goes down. Predefined loss if the market stays in the range, right? So now let us take this example. We had done Bank Nifty bull call ratio back spread. We sold 36,000 at 475 call. We bought 36,500, two strikes, 255. right? 475 and 510. Okay. Now, what are we doing? We know that in this strategy, the net premium we are paying is 35 rupees, 475 into 1, 255 into 2. So below 36,000, our loss is only 35, right? Then a maximum loss is at 36,500. So this is 36. This is 36,500. This is 37. And this is 37,035. Break even point is the distance between the two strikes. You add to the strikes you have got. So 37,000 plus the premium, 37,035. And from there, you have unlimited profits. So what is the difference between a bull call spread and a bull ratio back spread? First is unlimited profit if the underlying goes up. In a bull call spread, you have limited profits. Second thing, if the underlying falls drastically in a bull call ratio back spread, your losses are minuscule, right? Only if the underlying remains in the range between 36 and 37 will my losses increase, or the highest loss will be at 36,500. Predefined loss. Am I making sense? Predefined loss. Is this clear? So where did I tell you? Big gap down and the underlying closes near the low of the day. Big gap down or the underlying closes near the low of the day. When you make there, the big movements are expected. Is this clear? Good. So how is it going, my friends? Sudhanshu sir, Sudeep sir. Very quiet, Sudhanshu sir here. Now we are going to do the bearish strategies. When you are bearish in the market, they are mirror opposite of what we learned right now in the bullish one. Mirror opposite. When you are bearish and you know that the underlying is going to fall either through the help of technicals or through the help of market directions. So the bear put spread is a two-legged strategy. Traditionally involving at the money options and out of the money options. You can create the spreads with both in the money and out of the money options. Both in the money and out of the money options, right? To implement a bear put spread, what do? You're buying a put, higher premium. Higher premium, you're buying a put. You're selling a put, lower premium. Same quantity. One of this minus one of this. Same underlying, same expiry, same number of options. Right? You're buying a put. Right? Higher premium. Selling a put, lower premium. Same underlying. Same expiry. Same number of options. Right? Good. So let us take this example. Vikesh sir feels that since the momentum is not there in the breakout, Nifty is going to fall. Vikesh sir saw this example here. So Vikesh sir sees that there is a small correction because in the 2 days there is no momentum seen. So they say that when you have an opportunity to buy in a breakout, so there is a saying, I don't know how many of you have heard this. When there is an opportunity to buy in a breakout, it is not a breakout. How many of you have heard this saying? Can you see this? There was no opportunity to buy. You never got lower prices. See, you never got lower prices. So breakout means you don't get an opportunity to buy. You have to rush to buy. Am I making sense? So Vikesh sir feels that underlying is going to fall. How much? He feels that the possibility is that underlying can fall till 15,750. So what is he doing? For the 22nd of July, he is buying a put. So he is buying a 15,900 put. Okay, so Abhishek sir, when he buys a put, what is the challenge? He is paid 61 rupees. But if I see the Greeks, theta loss is 7 rupees 20 paisa. So if nothing happens on Monday, Vikesh sir will lose 15 to 21 rupees of premium. 3 days, Monday evening, he will lose 21 rupees. So Vikesh sir, he saw the chart. Now let us see the option chain. Let us see where there is Can you see 15,800 is the highest open interest? Right? Can you see this? So what does Vikesh sir do? His expectation is also 15,750. So what is he doing? He is selling 15,800. Right? So now can you see his theta loss is neutralized? So what is his risk? 30 rupees premium paid. What is his reward? Payoff is 100 rupees minus 30 rupees. 70 rupees. So what will be his break-even point? The strike of the put less the premium, 15,870. Right? So let us do this example in Excel. Right, my friends? So can we start? What will the price of 15,600? What will be the price of 15,900 put? In the money, strike, right to sell. Lovely Ramakrishna sir, 300 rupees. What will be this? In the money put, I have sold. So I have to pay minus 200. 100. The premium minus 30. What is my profit? 70. So 15,700. How much? I am selling. Lovely, Ramakrishna sir. You have really become a champion. How much time have you revised? Yes, Ramakrishna sir. 15,800. Lovely. Plus 100. 0. Limited loss and limited profit. 5,900. Both are 0. Only the premium loss. 16,000. Both are 0. Right? So when I draw this, what do I see? So till 15,900, my loss is minus 30. My break-even point is 15,870. Something like this. Limited loss, limited profit. So this is the PL curve or payoff curve on expiry. All these payoff curves are on expiry. Let's have a look. Can you see? Till 15,900, my loss is fixed. As the underlying keeps going down, my break even 15,870. And that 15,800, I get this. Am I making sense? So let us see the Greeks. Delta negative because we are bearish. Theta negative. Gamma positive, vega positive. Is this clear? Yeah. You can sell 15,700. If you are more bearish, Ramakrishna sir, then I would suggest you to take 29th of July expiry. Right? Then I would suggest you to take the 29th of July expiry. Sorry. Why? Because in a week, expectations are about 250 points. But for 2 weeks, underlying can fall more. So then I would suggest you do this. Is this a good trade? Yeah, if you are more bearish, then probably this is a better trade. But if you are looking at immediate fall, like in case of Vikesh sir, he feels that the underlying will either fall immediately or reverse on Monday. You have to understand the rationale for taking the trade. So Vikesh sir is taking a contra trade. What is he taking? It is called a contra trade against the trend. So in a contra trade, your results have to be quick and you have to exit quickly. Am I clear with this? Good. Is this strategy clear? The same way you can go down to the option chain, check out which strikes has highest open interest. So this was your 15,900, 15,800. Limited profit, limited loss. Right now we come down. Is this bull bear put spread clear? Everyone, are we on the same page? Shushantoda, is it clear? Vipin sir, is it clear? Welcome Kishan bhai, how are you? Welcome Avinash sir. So that is one of the techniques, Abhishek sir. Option chain and chart combined. Option chain and chart combined. That's one of the techniques. Avinash sir, what did you have for breakfast? Sudhanshu sir, you must know the rationale. The rationale is I must have a basis of taking a trade. Weekly basis, every week I cannot do a bull call spread or a bear put spread until unless I don't get the right entries. So you must define your entries. This is where I'm going to enter. Either this condition is met, then I will enter. Right? So directional trade always conditional in nature. It cannot be okay, I'm looking that it is good. Let me buy. Never. Okay? Good. Now we come down to bear call spread. So you're bearish in the underlying. Instead of a put, you are using a call. Just the mirror opposite. Right? So what are you doing? -1, +1. -1 call, you are selling higher premium. +1, lower premium. Same underlying, same expiry, same number of options. Right? Same underlying, same expiry, same number of options. So you are implementing a bear call spread. Okay? So when I am bearish, so let us basically do the same example. Instead of I'm selling the 15,900 call. Right? Now I can see this, if I'm selling a call, I can have unlimited losses if the underlying goes up. So what do? I buy the 15,800 call. Is this the right way of putting up a, what did I teach you? Is this the right way? What does it become? Bull call spread, am I correct? Is it a bull call spread? So what do I do to make it opposite? Opposite. I have to sell. Thank you, Yash bhai. Thank you. I'm just taking you through the various modifications. Now is it become a, I make money when the underlying comes down. Can you see this? -1 higher premium, +1 lower premium. Right? This is called a bear call spread. So let us do this example. ₹70 credit, right? Let's do this. What will happen when I'm selling a call? Underlying 15,600. Zero, 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 premium received. 15,700. Zero, 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 70. 15,800. Zero, 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 70. 15,900. What will be? Zero, minus 100, minus 100, 70. What will it be? Plus 100, minus 200, minus 100, 70. Right? So can you see? When I'm using a bear put spread or a bear call spread, same strikes, same expiry, right? Same strikes and same expiry. What do I get? Same PL. Do I get the same PL? Can you see this? Can you see the Greeks? They will be the same. Delta, negative. Theta, negative. Gamma, positive. Vega, positive. Am I making sense? Am I clear? So in normal case, Ramakrishna sir, we will only go. In normal case, we will only go for bear put spread instead of a bear call spread. But in only in one circumstances, we will go for a bear call spread. When I feel that upside resistance is there. So let us take this example. Because sir feels that Nifty has a strong resistance at 16,100. So what has he done? He has sold the 16,100 call. Right? Now he feels that this is unlimited risk. So what is he doing? He's buying the 16,400. Right? So my friends, currently IVP is only 2. If this is greater than 65, option premium will be expensive. Right? Then in such a situation, you have a better probability of receiving higher premiums because the premiums will be expensive. So this will become around 5,000 rupees. And your loss will also come down to 9,000. So your risk reward will be better. Is this making sense? Is this clear? Right? So you will have to do with a strict stop loss. While always remember in these types of trade, where your max profit is much lower than your max loss, you have to exit with a stop loss. So in this case, your stop loss will be at 16,100. In this case, your stop loss will be at 16,100. Am I making sense? Am I clear with this? Good. So let us do that Excel quickly. Bear call spread. So in this case, what are we doing? 16,100. 16,400. Call. July 29. Right? 51.1. Resistance. 6. So 45.5 is the net credit, right? Right? So what will happen? 0, 0, 0, 45.5, 45.5. 0, 0, 0. Premium received is the maximum profit. So all of you are aware now. 16,100, 0, 0, 0. So can you see now my losses will start increasing from 16,145. What will this be? Minus 100, 0, minus 100, 45.5, 55, 54.5, minus 200. Can you see minus 300? Am I making sense? Am I clear with this? Good. So have you understood that when IVP is greater, these option premiums are going to be much higher. So when they are much higher, my credit received will be much higher and my losses will reduce substantially. But in these types of strategies, always remember that you must always play with the fixed stop. So you have to, what is your stop here? 16,100. Because after that, you're going to have a big loss. Am I making sense? Good. So was this easy? Was the bearish strategy easy than the bullish one? In fact, we are just revising. So just see the PL curve. Can you see this? How did you get this? You were selling the 16,100 call. Unlimited loss. You're buying 16,400 call. Right? So this is how the PL curve happens. Am I clear with this? Right. So we are going to do the last directional strategy today. Right? The last one. Hello, Manish sir. How are you? How's everything? Shivastav sir, how are you doing? No, Sudhanshu sir, your understanding is not correct. Sudhanshu sir, you will select the strikes on the basis of your understanding of the chart as well as the option chain support and resistance, where you feel will be the possible profit booking areas. So it will be your call completely, either through the charts or through the option chain or through your understanding that this is where there can be a profit booking area. Am I clear, Sudhanshu sir? So I'm just teaching you the various probabilities. Good. Rajesh bhai, are you there? How are you, Rajesh bhai? I think so a lot of you are in office today. Good. Nice to see India working. Absolutely good, Sudhanshu sir. Find your own method. Combine all the processes and methods. Right? So directional strategies, bearish, put, ratio, back spread. You are extremely bearish. Right? You're extremely bearish. And you're expecting underlying to fall quickly. As I told you, maximum 4 trading session cannot be more than 4 trading sessions. So to implement this, -1 bear put spread, leg 1, +2 leg 2, -1 leg 1, +2 leg 2. All strikes belong to the same underline. Same expiry. The puts of leg 2 should be double than that of leg 1. So basically what are we doing? We are bearish. We are expecting a quick fall in the markets. Very quick. So let us take this example. Sudhanshu sir is expecting Bank Nifty to fall very quickly. So 26th August, 35,500 put. He's selling 1. He's buying 2 of 35,000. Right? So he sold 1. So let us do this physically in the exercise. Okay. So let us now do what is the premium. 553, and he's buying 388. Yeah, so 776. Lovely. So when you are selling, you receive it. When you're buying, you have to pay. So what is the net premium paid? 388 into 2, 776. 223 is the net premium paid. Right? Now let us see. What happens when it is 37,000? Both the puts are 0. Pay of 0 minus 223. So the only loss is the premium loss. 36,500. Both are 0. Only loss is the premium loss. 36,000. 0. 0. Avinash sir, am I making sense? Good. 35,500. What is 36,000? Lovely, yes, sure. Minus 500, not plus, because I'm a seller. Am I making sense? Am I clear? Good. 35,000 minus 1,000. Lovely, Anand sir. How many times have you revised? You are a true champion, Anand sir. True champion. 34,500 minus 1,500 plus how much? 1,000 into 2 is how much? 2,000. Lovely. Plus 500. 227. Am I making sense? Good. 34,000 minus 2,000. Lovely. Plus 1,500 into 2, 3,000 plus 1,000. What do you see? My loss is limited. Minus 223. Loss goes up from 36 to 35. Then break even is 35 minus the premium. So the difference is 35,000 minus the premium paid. So 223. And from there, I have unlimited profits. Am I making sense? Bearish. Expecting the underlying to fall quickly in the next 3-4 days. Minimum 20 days to expiry. Am I making sense? Is this clear? No, this cannot be used in the weekly expiry. Why? Theta loss. Minus 1 plus 2. Same underline, same expiry. Double than that offer. So what is that? Limited profit if the underlying goes up. Limited profit loss. Unlimited profit if the underlying goes down. Predefined loss if the underlying stays in the range. Same way, what should be our goal? What should be our goal? Either the underlying goes up or goes down. It should not stay in the range. So we should find those periods where either the underlying moves up or moves down. Lovely, Ramakrishna sir. Gap ups and higher closings. Let us see the chart. Gap ups and higher closing. Can you see this? Gap ups, higher closing. So in the next 3-4 days, what happens? Went up, right? Next 3-4 days went down, right? Gap ups and higher closing. Next 3-4 days came down. So this logic will work up. This logic will work. Am I making sense? All right. So then, my friends, I just wanted a suggestion. There are a lot of people who are saying that we want a strategy reckoner, advanced course. Where can you do the practical example of the strategy? What do you think? Is it a good idea to do that? Back testing like we have done short straddle, can we do that? Same way we can take out these conditions and we can go like the election result. We back tested those strategies. Is it a good idea to do an advanced practical course? No, Avinash sir is right. We must not do a course. Good. Thank you for your suggestion. Volatility, Yash bhai, will always be higher. So what are the Greeks? Please see the Greeks. Delta positive. Can you see the theta? This is the major problem. Sorry. Oh, this is the wrong one we have done. This will be 2. Delta should be negative. So can you see this? Delta negative, theta negative, gamma positive, vega positive. So that is the reason why we do monthly expiries, 20 days to go minimum. Why? Because the theta impact is much higher. Theta impact is much higher. Right? Is this making sense? Is this clear? Good. So now let us do this cheat sheet. Bull call spread. We have done. Now let us come down. Bear put spread. Delta negative, theta negative, gamma positive, vega positive. Money flows out, strong momentum. Volume and open interest. Weekly and monthly support levels. Taking resistance. So the call which we took today was our assumption that it is taking resistance At the previous breakout level of 15,900, it is not able to cross, right? So the second one, bear call spread. So when are we going to use a bear call spread? IBP greater than 65. Selling a call out of money, higher premium, buying far out of the money calls, lower premium. Strong resistance at the levels where we are selling the call. This is to collect theta as option premium. A stop loss, underline 36,000. If it crosses this level, you need to square off, right? Is this making sense? Next one, bear put ratio back spread, minimum 20 days. Big gap up. So let us use the word gap up. Let us not forget the word reversal, because problem with reversal is to define it. Big gap up and closes at the high. Close near the high of the day. This is a better way to define it. Am I clear? You're selling one lot of higher premium, buying two lot of lower premium. Maximum holding days, 4 days. Is this clear with everyone? So congratulations, you all have completed the directional strategies. Are all the 6 directional strategies clear with you all? Number 1. So now we are not going to repeat this. Bull call spread +1 -1. Same underline, same expiry, same number of options. Bull put spread -1, higher premium, +1, lower premium. Same underline, same strikes, same number of options. Right? Ratio, call ratio back spread, -1 +2. Unlimited profit if the underline goes up. Limited loss, predefined loss if it stays in the range. Bear put spread. So now we've done the bullish. So always remember directional bullish, delta positive, theta negative, gamma positive, vega positive. Only in bull put spread, out of money strikes, delta positive, theta positive, gamma, vega negative. Right? This is OTM strikes. Am I clear? Is it clear? Bull put spread, out of money strikes, only there you will get this particular thing. Am I clear? Good. Now we are going down to the bearish strategies. When you know the overall trend of the market is down, bear put spread, 2-legged strategies involving at the money, out of the money, or in the money, out of the money. +1, -1, higher premium buying, lower premium selling. Same underline, same strike, same number of options. +1, -1. Is this clear? Limited profit, limited losses, bear call spread, credit strategies, -1 call selling higher premium, +1 lower premium. Same underline, same expiry, same number of options. -1 +1. Is this making sense? Where call spread. Now we come down to put ratio back spread. -1 +2. -1 +2. Same underline, same expiry. Put of leg 2 should be double than that of leg 1. Unlimited profits if the underlying goes down. Limited profit or losses if the underlying remains up. A predefined loss if the underlying stays between the range. Right? Put ratio back spread. Any questions? Good. So how is your Josh now? Kunal sir, how is your Josh? Jatin bhai, Jagat bhai. Always remember, attitude is what you have. Money can come, money can go. People will come, people will go. But your attitude and your spirit is what you take in life. Right? So even when things are down and the chips are down, don't give up. Keep that attitude. And I'm special and I'm going to make it happen. Absolutely correct, Rohit bhai. Nice to see you today, Rohit bhai. You're very quiet today. What has happened, Rohit bhai? Did you do your revision? Come on, Rohit bhai. Give a breakout. Don't feel resistance. Right? Good. Non-directional strategy. When you don't know the direction of the market, but you're expecting fast movements either side, like the case of budgets, elections, long straddle, long strangle. Like the case of budgets, like the case of elections, long straddle, long strangles. Right? Or one is expected a range bound movement. We can employ the short straddle, short strangle, butterfly, condor, iron condor, calendar spread. Right? Now I have already taught you short straddle and short strangle. We did and we are practicing. How many of you are practicing every day? Good. Abhishek sir, I know you're very excited. Money comes and money goes. I am not very much, it does not motivate me, money. I'll tell you something. What motivates me is the power of freedom. Right? That motivates me. Money, if you double your capital, you can make 20,000 in a week. That's not important. But it's your power of freedom. Right? Very good. Biju sir, I'm very impressed with you. You have worked your own way. Lovely. I'm impressed. I'm impressed by people like Biju sir. They are doing their own works. Right? So Biju sir, Strangle will give you more profitable days but less profits. Always remember, more profitable days, less profits. Short strangle. So your average profits will be lower, right? So you have to make a choice where you want to be right 80% of the time or you want to make more money. So that's the choice you got to make. So what I want is financial freedom from all of you all. I want you all to work on it. So I give you a short hint, Biju sir. Strangle will do well on Wednesdays and Thursdays. It will not do well on Fridays and Mondays and Tuesdays. Okay, since you are hardworking, I have given you a hint. A strangle does not do well on a Friday, Monday, Tuesday. It works well on a Wednesday and a Thursday. Theta impact is highest on Wednesdays and Thursdays. Good. But the drawback in a short straddle and a short strangle is unlimited risk. So that is why we are doing only intraday. We are not carrying that positions. So I always keep telling my students, doing without a stop loss or a strategy which has unlimited risk, you are signing on your death warrant. So never do those strategies where the risk is not in your control. Okay? Never do those strategies. So what do we do? Short straddle, short strangle, butterfly, condor, iron condor, calendar spread. So we've already done butterfly, condor, and iron condor. So what is a butterfly? Neutral strategy. So when do I employ a butterfly? Sukhbir sir, Avinash sir, Yash bhai, Kishan bhai. Range bound market near to the expiry. The right word is range bound market near to the expiry, and you are expecting the underlying to close around the middle strikes where you are selling the options. So highest premium +1 buying, selling to middle premium on the middle strike. Third one, lowest strike, lowest premium. +1 -2 +1 butterfly, right? So when you are near to the expiry, what will you get? You will get this theta impact on the middle two strikes. Okay? All area of the same expiry. The distance between the strike 1 and strike 2 should be the same between the strike 2 and strike 3. Lovely Anubhai, vada pav. Lovely. So near to the expiry, weekly ones, this is the best. Vada pav. That's how you remember. Whether you do a butterfly with a call or with a put, so what is it? How does the butterfly come? +1 -1. -1 +1. So here is bought the 30, sold the 40. So like this. Sold the 40 strike call, bought the 50. Like this. So the break-even point is the combined premium. So let us do this example which we have already done. If you remember, we had done 15,900, 105. 16,126, 16,300. So the net premium was 58 points, right? So what will be my break-even point? 15,900 plus 58, 16,300 minus 58. This will be my break-even. So limited profit, limited loss. Maximum loss is the premium paid. Maximum profit, what is it? At 16,100. Where 16,100 call and 16,300 call. No intrinsic value, no time value, will be 0. So where will be my break even? 15,900 plus 58. So this is going to be my range. Lower end 16,300 minus 58. So till this range I'm going to make money. Am I making sense? Am I clear? So whether I do a butterfly with a call or a put, it is going to be beneficially. The result will be the same if I use the same strikes. Right? So let me do the option cheat sheet one more time for the butterfly. Range bound market. Strategy to be done near to the expiry. Where you are expecting the underlying to close near the middle strikes. You're selling options. +1, -2, +1, delta neutral. Theta positive. Gamma negative, vega negative. So all these range bound strategies, more or less your delta is going to be neutral. Am I making sense? Good. The difference between strike 1 and strike 2, strike 2 and strike 3 should be the same. Now we come down to condor. Variation of the butterfly, limited risk, non-directional, limited profits. So near to the expiry, security is perceived to have limited volatility because you're expecting and predicting it to close in a range. Right? Very good, Anup bhai. In the money call. Selling a call, higher strike. +1, -1. -1, +1. Hello, Abhinav sir. Very nice. Right? So let us do the practical example we did. Right? We did not do a condor. So let us do a condor. Practical example. Right? So the possibilities are that Nifty perception is between 15,900 and 50 You bought one strike. 15,850, you sold one strike. $15,800, you have sold another strike. And 15,700, you have bought the last strike. Right? So we have done a condor. Looks very nice. Beautiful strategy. Very nice. Let us do this. What are the strikes we've taken? 15,950. 15,850. 15,800. 15,700. Right? Plus 1, minus 1, minus 1, plus 1. Right? So what are the payments we have done? 84, 43, 31, 60. ₹26 we have made a payment, right? Right. Let us do this condor. So can you see the difference between the strike first and second? 100, between third and fourth, 100. So distance between the first and second, third and fourth. So now let us do this. What will it be? If Nifty is 15,600, 350 minus 250, right? What will this be? Minus 200 plus 100. So 0. The net difference is the premium paid. 15,700. 250 minus 150 minus 100. 0. 0 minus difference is only the premium paid. Right? 15,800. 150. 50. 0. 0. 100. 26. 74. 15,850. 100. Right? 100. 0. 0. 100. So what is the difference between a condor and a butterfly? Can you see my profits are between the second and the third range? My max profit now 15,950. 0. So let us make it 15,900. 50, 0, 0, minus 26 plus 24. 16,000, 15,950. 0, 0, 0, minus 26, minus 26. 16,000. 0, 0, 0, 0, 0. Minus 26, minus 26. Can you see this? So what will be my break-even point? The first strike in the put. So 15,950 minus 26. Last strike plus the premium, 15,700 plus 26. Is this condor clear? Limited profit, limited loss. In a maximum profit is between second strike and third strike. Am I making sense? Is the understanding clear? Right. Any questions? So what are the Greeks? Lovely, Anup sir. Delta negative, theta negative or positive. It is always going to be positive. Range bound strategy. So here delta will always be slightly negative or slightly positive, which is called neutral. Right? Theta positive. Vega negative, gamma negative. Am I making sense? Good. So variation of butterfly condor. Right? Now we come down to iron condor, limited risk non-directional strategy. It is designed to have a large probability of earning. So what is the difference here? Your risk per trade will be higher than your reward, but your probability of being right will be more in an iron condor. Why? Because the range is wider. -1 +1. What am I doing? I'm selling a call -1. I'm buying a call which is far out of the money. Selling a put -1. Buying a put far out of the money. Lovely combination of a bear call spread and a bull put spread. You remember we did this OTM, far OTM. What is this? Bear call. -1 OTM put +1 bull put spread. When I combine both of this, what do I get? A range. Maximum profit is much bigger. Maximum loss is much bigger than the maximum profit. But my range is wide. My range is wide. Am I making sense? Good. So this is a must strategy to have in your portfolio. A must strategy, right? Iron condor net credit, condor net debit. We receive a premium, and we have to pay a premium. Both are employed in a range-bound market direction. Now there is something called fly condor. How many of you heard it? So let me take you to iron condor. I hope you've done it. You remember this? Nifty, you are selling the 16,400 call. Nifty's current price is 15,900. Right? You're selling the 16,400 call 70, buying 16,800 call. Far out of the money. OTM, far OTM. You're selling a OTM put. You're buying a far OTM. Right? What do you see? Only when it goes outside the range, 16,400 and above, you will lose money on the call side. Only when it goes below the range of 15,600 and below, you will lose money. If it remains in that range, right? If it remains in that range, you're going to have profits. We saw this. Am I clear? So when you know that this is possibly a range-bound markets, right? Range-bound markets. This strategy will give you money. Now, what is a fly condor? A fly condor is when you select, when you are expecting underline to close, say on the 29th at 15,900. So what are you doing? You are selling the same strike call. You are selling the same strike put. Same strike call, same strike put. Right? And you're covering it up. With the out of money call. And out of money put. Absolutely covering at the break-evens. So it is something sort of a butterfly. Can you see the wings? Can you see the deltas? Slightly neutral, slightly negative or slightly positive. Theta is positive, gamma negative, vega negative. Loss is defined, profits are defined. Maximum profit is at the strikes. You are selling the same strike call and put. So that is basically nothing but the short straddle, 15,900 short straddle. So your expectation is around 15,900 there will be an expiry for 29th of July. Am I making sense? Am I clear? Absolutely. Good. Now the last plain option strategy is called calendar spreads. So when the expectation is that the price is going to close near a strike price, right? When you are expecting, Jagat sir is expecting Nifty on the 22nd of July to close at 15,900, right? What is Jagat sir expecting? That on 22nd of July, Nifty is going to close at 15,900. So what has Jagat sir done? He has sold 22nd of July, 15,900 call. At the same time, Jagat sir has bought the 29th of July expiry. Same strike call. So calendar means different expiries. So 22nd of July, he has sold the 15,900 call. 29th of July, he has bought the 15,900 call. So what is the premium he is paying? So let us assume 144, right? 60 rupees. So his maximum loss will only be the premium paid. Sorry, Anand sir, my maths is weak. 50 rupees. His maximum loss is only the premium paid. Right? So if on 22nd of July, he will square off his position. If Nifty closes at 15,900, this call will be 0. This will be in the money call, 150 rupees. Payoff is 150. His profit will be 100. So you will never know the exact profit. This is wrong. The max loss is defined. Because even if underlying goes anywhere, he cannot lose more than the difference of the premium. So it's a limited loss, limited profit strategy which is deployed. Right? Now let's have a look. Let's do this. Calendar spread, 15,900 call. ₹50. Now, where will be the maximum profit? 15,900, right? Because at this area, this will be in the money, 150, 100, and 50. You will receive 100 rupees. Now at 16,000, this will become 100 rupees intrinsic. So minus 100. This will be 165, 195. So this is, you will never get this figure because we don't know the IV, but it will be roughly around 195, right? 15,800, this will be 0. This will be somewhere around 100. So limited loss, limited profits. 15,800, this will be 0. This will be around 35 rupees. 35 minus 50 minus 50. Right? This will be 0. This will be 15 rupees. So limited loss, limited profit. 16,100. This will be minus 200. This will be minus 245. So when it stays around the range of 15,900, so the point is 15,900 plus minus a certain value, A and B. That is where you will make money. If it moves outside the range, limited loss, limited profits. Am I making sense? Am I clear? Right. Now, what is the difference? There is a difference in the Greeks. No, Ramakrishna sir, when I'm discussing a strategy, both strategies are entered together, both strategies are exited together. So on the 22nd of July, you will exit this trade together. So the maximum holding period of a calendar spread is 22nd of July. Am I making sense? So if I look at the Greeks, delta neutral, theta positive, gamma negative. Can you see the Vega? The Vega is positive. This is the only non-directional strategy where Vega is positive. Only non-directional strategy. So if you are expecting big movement, you will use calendar spread. So example, you are expecting an event on 26th of July. Event. So you know till the 22nd of July, since there is no event, no major movement that happened. So this premium will be zero, but this IV will not fall of the 29th expiry. This IV will not fall for the 29th expiry because of the event. So when I'm a buyer of this strike, I will get this benefit of this IV. Am I making sense here? Am I clear? Good. Lovely. So whether I do a butterfly, a calendar spread with a put or a call, the result will be the same. I can do it with a call or with a put. Am I making sense? So let me take you to this. So when the expectation is that the price will close near an expected strike price, a calendar spread is undertaken where the same strike of call current month expiry is sold and the same strike far month is purchased. Near to the expiry, if the underlying price remains near the strike price, it will have a lower value. Time value decay is faster in near expiry compared to the far expiry. So I'm buying a call far month, selling a call current month, same strike. Right? Long expiry with the put, the same expectation. You're buying a put far month, selling a put current month. Is this clear? So congratulations, my friends. You have completed. Wide range underlying move during the expiry, max profit lower than max loss. We've done this. Now the calendar spread, different expiries, same strike or call or put, range bound expectation, delta neutral, theta positive, gamma negative, vega positive. Right? So especially when there is event in the strike where you're buying, it's a good trade to take. Am I clear? Good. Lovely. Congratulations, all of y'all. We have completed all option strategies. How is it feeling? Long straddle, long strangle, short straddle, short strangle. Bull call spread, bull put spread, bull call ratio back spread, bear put spread, bear call spread, bear put ratio back spread, butterfly, condor, iron condor, calendar spread. How is it feeling? Great. We will come. Ramakrishna sir, what is to be used? We will come. Good. Let us take a break. 11:26. Let us come back by 11:36. So let us keep it 11:40. Take a 14 minutes break. Come back with a fresh mind. We're going to learn something different. Covered call, married put, what is called hedging, and collar. Come back with a fresh mind. See you at 11:40. Welcome back. How has been your break? How's it going? You know, I've been very impressed with this batch. Most of you guys are TMP students, but the dedication of this batch has been brilliant. You know, trying to make out a method, trying to fight it out. Lovely. You see, every journey takes time. I know these strategies might take time, but there is a journey part to it, and you must enjoy that part. That is important. Right, all set. Anup bhai, how are you liking? Good. Synthetic long future. So what is the word synthetic according to all of y'all? When you create a position without the use of that position, with the help of others' position, is called synthetic. So when we were young, probably I think so, we heard that synthetic material, this is pure cotton, this is synthetic. So when it is made of different materials, it's called synthetic. So when I'm creating a futures position with the use of options contract, it is called synthetic long, right? So let me take you to futures long. So when I'm adding a futures contract long, what do I get? Underline goes up, my profit goes up. Underline falls, I'm in a loss. Underline goes up, my profit goes up. Underline falls, I am at a loss. Can you see this payoff graph? Now I'm deleting this. Now what am I taking? Simple formula. One lot of same strike call is bought. Same strike means any strike. I'm buying a call and I'm selling a put. Same strike. So what am I doing? I'm buying a 15,900 call. Right? And I'm selling a 15,900 put. I'm buying a call, selling a put, both of the same strike. Can you see this PL? Am I making sense? Is it like that of the futures? Now let me change this. Let me take it to 15,500 call. I'm buying the 15,500 call. Selling the 15,500 put. Can you see the PL? Is it the same like that of long futures? Can you tell me why this is the same? Lovely, Yash. Can you see the delta? If you have noticed at the money call, what is the delta? 0.5. At the money put, what is the delta? Minus 0.5. So when I'm doing plus minus this, is the delta equal to 1? Call minus put, is the delta equal to 1? So my friends, what is the delta of a futures contract? Lovely. Now, let me take 16,000 call and put. Absolutely, it is possible. Why not? They will buy. Now, can you see the Greeks? Delta, can you see? Call 0.42. Put, the normal delta is 0.57. So can we say that the delta and the call and the put absolute value is 1? Absolute value of the call and put. So do you now know at the money call and put 0.5 minus 0.5? So any strike call and put absolute value is sum total is 1. Are all of you on the same page? Jatin sir, Kishan sir, Shivastav sir. So what is the formula? C minus P, call minus put. Both should be of the same strike, equals to long futures. C minus P equals to futures, same strike. Am I making sense? Am I clear why this formula is working? Because the absolute value combined call and put of the same strike will have a delta 1, which is the same delta of that of long futures. Same delta. Any questions? Any questions? Are we all on the same page? Ramakrishna sir, this is like a future. It will have the same margin, around 1 lakh. If I have the payoff like that of the future, unlimited profits when I'm making money, unlimited loss when I'm losing money. Synthetic long is created when I'm buying the call, I'm selling the put. Both should be of the same strike, same expiry of that of the futures. So the future is on 29th of July. I will buy the 29th of July expiry call, sell the 29th of July expiry put. So what is the call put parity equation? I told you C minus P equals to futures. What is it? C minus P is equal to futures. So C minus P minus futures equals to 0. Is this equation clear to all of you? C minus P minus futures is equal to 0. Now, how do I do this? So, Shivastav sir, as per this equation, C minus P minus futures equals to 0. So, if I put this equation here, 16,000 call I have bought, 16,000 put I have sold. So, what do? I sell the futures and it should be equal to 0. Now, what do I see? In this equation, in this payoff, I'm having a maximum profit of 45 rupees. We know on the last day, this equation will close at 0. But right now, if I take this trade, wherever the underlying goes from 18,000 and 14,500, it is going to remain at 0. But I'm getting a profit of 45 rupees. Why am I getting a profit? This is a mispricing. In real life, on the last day, this will close at 0. There is a mispricing between the call put and futures. So this call put parity equation, the risk is 0. Can you see this? There is no loss. The risk is 0. So this is called arbitrage. How many of you have heard the word arbitrage? Arbitrage is limited profit, 0 loss. When I create a position of similar underlines where my profit is limited, but there is no loss. Am I making sense? So Vikesh bhai, now what has happened? We come to that. So during market hours, whenever there is a mispricing, you can use this equation and you can have an arbitrage opportunity. But now, is this possible to do arbitrage here? What is my profit? Only 45 rupees. So during the day, when there is big movement, and if I am getting an opportunity of 1,500, 2,000 rupees to lock in profits, then I can do arbitrage. But in such a scenario, where the profits are just 100, 150, there are brokerage expenses, there are spreads charges, because I'm executing 3 trades together. I'm squaring of 3 trades together. So manually, in this world, this arbitrage opportunity is very difficult to execute. This arbitrage opportunity is very difficult to execute. So how do I do that? So for us, how many of you have heard algo trading firms, high frequency trading? How many are from NCR region? Anand sir, if you go down to NCR, there will be number of ones. Most of the high frequency trading firms are in NCR who have come from abroad. They have super fast hardwares. And they take these trades to the next level because the softwares are also extremely good, right? So they take this trade to the next level. So for people like you and me who are doing these trades by hand, paying expenses like government costs, like STT, brokerage, slippages, bid and ask difference, and brokerage, it is impossible for us to make money in arbitrage now. Impossible. So how do I do that? So if I'm telling you, you cannot do arbitrage, so what is the use of teaching you this equation, C minus P? So Ramakrishna sir, I cannot do this, use this equation in arbitrage, so then why am I teaching you this? Why am I teaching you this? Have you thought about it? Anyone? Hari sir, how are you? Have you seen this equation, C minus P equals to futures? Sudhanshu sir, C minus P less futures equals to 0. Sudhanshu sir, you have bought a 15,700 call at 100 rupees. Tomorrow Modi ji announces a 20 lakh crore stimulus. What will happen to Nifty? What will happen to Nifty? Huge gap up, 16,400. Now, Sudhanshu sir, are you aware in the early morning, if there is more than 40% rise in the value of option, there is a circuit. You cannot square off your positions. Now you want to square off your position, but you cannot. Right? So what will you do? So Sudhanshu sir, you've already purchased the call. So by this equation, you are going to sell the futures at 16,400. And you're going to sell the 15,700. So now with the help of this future, you are going to square off your position. Assume Nifty closes at 17,000 for the expiry. Your call premium is how much? 1,300 rupees because 15,700. Your put will be 0. Your futures will be how much? 16,400 minus 17,000 minus 600. So what is going to be your net profit? Plus 1,300 minus 600. What is going to be your net profit? 700 rupees. Assume Nifty closes at 14,500. Your call will be 0. Your put will be minus 1200. Right? In future, 16,400 minus 14,500. So what is going to be your profit? 700. Assume Nifty closes at 0. 15,700. Right? Can you see this? Wherever the underline goes, through the help of this equation, my payoff is the same, 700. So can you see how this equation helps you to book your profits? So my friends, a lot of times in life you will see that options have become illiquid and you cannot square off your positions. What will you do? You will use this equation to book your profits. Am I making sense? Am I clear? Good. Avinash sir. Had sold a call. Avinash sir had sold a 15,700 call. Now this call is at circuit. He is scared. He is not able to square off his call. How is Avinash sir going to react? Now we all know if we opposite this equation, future minus call plus put equals to 0. If I just take it other side, future minus call plus put is equal to 0. So now what will Avinash sir do? If he wants to buy it, he will buy the future at 16,400 and he will buy the 15,700. Right? Now if Nifty closes at 17,000 for the expiry, how much is the loss in the call? 1,300. Put will be 0. Futures, what is it? 600. What will be his loss? 700. Am I making sense? If Nifty closes at 14,500 for the expiry, call 0, put plus 1,200, futures minus 1,900, 14,000. So let us use this 15,700. 0, 0, minus 700. Am I making sense? Am I clear? So everything has a reason. So this equation helps you to understand the difference and how to square off. So can we see this is the linking space between the call and put with futures. This connects all the three together. Put call parity equation. I always just a bit of philosophy. Yeah, this is also good when your options become illiquid. Absolutely correct. There's always a philosophy. Life can always be understood backward, but it has to be lived forward. You don't know the purpose. So you learn the purpose very later on in life. Am I making sense? Is this clear? Now, we come to the first futures and options combined strategy, covered call. Is a strategy where I am buying an underlying instrument either in the cash market or the futures, and I'm selling the call on the underlying asset to generate income. What am I doing? I am buying the underlying in the cash and I'm selling a call of the underlying asset to generate income, right? So that is called covered call strategy. Okay? No, Ramakrishna sir, you're completely wrong. Let us practice. How many of you do covered call? How many of you trade in futures? Bhavin Bhai has bought Reliance futures 29th of July. This is Reliance futures cash. Is this clear? So what has Bhavin Bhai done? He has bought Reliance future at 2116. Now Bhavin Bhai feels that Reliance has a resistance at 2200. Right? So what is he doing? He is selling a 2200 call option. So what is he doing? He sold. So what is the first one of the strategy? Buying futures. What is the second part? He has sold the 2200 call option. So when I combine this, what do I get? I'm receiving the premium of the call. Unlimited loss. And what happens? This 15 rupees is credited. 2116 minus 16. So my profit is 16 rupees. So what is my break-even point? 2110. Less the premium received. But below that, my loss is unlimited. But my profit above 2100 will be limited. 2100. 2100. My profits limited, loss unlimited. Am I making sense? Am I clear? Bhavin Bhai, loss unlimited, profit limited, above 2100. My maximum profit will only be 24,700. Is this a good strategy? And how do I solve this? No, Abhishek sir, you cannot do this. Yeah, even if you're buying in, I told you, you can either buy in future or in cash. Anup bhai, do you know that this is the most used strategy in the world? Please understand, this is investment strategy. This is not a trading strategy. If I'm getting 16 rupees for 10 days, if I'm doing for monthly, how much will I get? 35 rupees, 40 rupees, 2% a month. If I'm getting selling a call, 2% a month if I'm getting selling a call, and I'm bullish in the stock. I know I'm bullish on Reliance for the next 3 to 4 months. Right? Absolutely correct. So Bhavin bhai, you are bullish in the underlying. Even if the stock falls by 5-10%, you are not bothered. So this is a positional strategy. It is not a trading strategy. So if I'm getting 2%, Avinash sir, a month, how much is it in a year? 24%. If I can get 24% plus 10% capital appreciation or 8% capital appreciation, how much is it? 32%. Am I making sense? Am I clear? So this is a strategy not for traders. It is investors who are bullish in the underlying for 6 months to 1 year minimum, and you will only do this in blue chip stocks. You will not do this in cash market stocks. What is the blue chip stock? Evergreen stock, right? Yes. So what is the, yes, Nifty 50 stocks, TCS, Infosys, ITC. Very good, Larson. So you must buy it in the cash market. Okay, so what happens when the call, so if you have bought this, what happens if Reliance goes to 2300? Future, what will you make money? 2300 minus 2116. 184 profit. Call, what will happen? 100 rupees loss. So net payoff is 84 plus the premium received 15 rupees. So if the underlying goes up, I will make money. So where you feel that there is a resistance and you are bullish in the stock, so for that particular expiry, you can sell the call of that strike price. So what happens? Your profit is fixed above that strike price of the call. Max profit is fixed. But you start receiving premiums. So this is the most common strategies which are being used by HNIs and traders. Why? Because this monthly premium credit is a very big, lucrative, which reduces your cost every month. Which reduces your cost every month. Am I making sense? Am I clear? Good. So my friends, You can either buy in the cash market or the futures. And if you sell, so what are the conditions? Bullish. You must be bullish in the 6 months to 1 year. Point number 2, only in blue chip stocks where option activities are liquid. Now, my friends, one lot selling one same quantity, same expiry. Where have you seen this equation? Have you seen this somewhere? Limited loss, limited, or a lovely yes buy, limited profit, unlimited loss. So what was the equation? C minus P minus future equal to 0. So minus P is equal to futures minus C. Is this nothing but minus P? So my friends, if you are a trader and you want to do this strategy, don't do this. Just sell a put. It is nothing but selling a put. Right? But if you're an investor and you have the stock in your portfolio, either in cash or in futures, then you can employ this strategy. Am I making sense? Is this clear? Good. How are you liking this? So this is employed by number of HNI investors. A lot of investors, they do this strategy to earn time value premium. Is this clear? Good. Point number 2, married put. How many of you heard the word hedging? How many of you heard the word hedging? You remember we did delta neutral hedging, Abhishek sir? So hedging means protection against your position. Biju sir, that is what you have to decide as an investor. When do you buy the underlying? That option strategies cannot teach you. Have you done technicals, Biju sir? Yes, use your technical knowledge to find your entry points. Married put is against your long positions in futures or in the cash market. You are buying puts to protect your downside loss. Because for every long position, either in cash or in futures, you can have unlimited losses on the downside. So to protect the unlimited loss, I am buying a put. So what am I doing? Take this example of Reliance. You have bought either in the cash market or in the futures market Reliance at 2116. Now there is a chance of an India-Pakistan war. Now you know that if this war happens, there can be a fall in Reliance price. What do you want to do? You want to protect it. So in order to protect it, what are you doing? You are buying a put. So you're buying a 2100 put. Strike price. And paying a premium of 29 rupees. Right? So when you're buying a put, you're paying from your pocket. So your break-even point will be your entry price plus the put price. 2116 plus 29. 2146. Now you know that below 2100, this put will protect you. So what is your maximum loss? 46 rupees minus 2100. That is 2146 minus 2100. So 46 is your maximum loss into the lot size. So you know that maximum you can lose is 46 rupees below 2100. And above 2146 you have unlimited profits. Above 2146 you have unlimited profits. So what is this strategy? Unlimited profits. Maximum loss is limited to the point defined. This is called a merit put. You remember we did delta neutral? Did you remember this was long futures, long put? So this became this position like this. Now we added one more put. What did it become like this? You remember delta neutral? Two puts at the money. Do you remember this? So this is only one put. How many of you remember delta neutral hedging? All forgotten? Very quickly. So instead of this, we are just buying one put, Subramaniam sir. So when I am buying a futures and I am buying a put, it is called a merit put. Is this clear? Where have you seen this payoff? Where have you seen this payoff? Lovely. What is the equation? C minus P minus futures equals to 0. So C equals to futures plus put. So if I'm a trader, I don't need all these things. I can just buy a call. So if I'm buying a call, it is solving my purpose. But if I'm an investor and I already have Reliance in my portfolio either in futures or in cash, and if I want to hedge, I have to use this equation. If I have to hedge, I have to use this equation. Am I making sense? Am I clear? Good. Now, so maximum profit limited, maximum loss is limited. The strategy is nothing but synthetic call. This is the payoff of a merit. So this is called hedging. My friends, is this clear? When I am buying a put to protect against my unlimited loss in a futures or a call is called a hedge. So when I buy one at the money call, it is called normal hedging. And when I'm buying two at the money calls, it is called delta neutral hedging. Is this clear? Good. Now to the last strategy for the day and your last one. Caller strategy. An option trading strategy where you are buying the underlying in cash or futures. You are buying a put as a protection and also selling the call to receive this premium. So my friends, when I see this, if I'm buying 30 rupees every month or 50 rupees, this is for 2 weeks. How much premium am I paying? Around 550 rupees a month, a year. If I keep continuous hedging, how much premium am I paying? 550 rupees a year. 25% to 30% of the cost. If I'm paying 25 to 30% of the cost, can I survive? Does Reliance move by 25-30% every year? No. So what do fund managers do, my friends? They know right now that Reliance might take a resistance at 2200. So what they will do? They will sell this 2200 call. It's a combination of covered call and merit put. So when you're selling a call, your upside is limited. You are neutralizing your premiums, right? So now I'm just paying 14 rupees from my pocket, right? So my break-even point is 2116 plus 14, 2130. So my maximum loss will be 30 points, 2130 minus 2100. And my maximum profit will be 2200. So that will be about 70 points. Limited loss, limited profit, underline goes up. Where have you seen this strategy, my friends? Bull call spread, lovely Robin Bhai, lovely others. So when you are bullish as an option trader, what will you do? You will not create this strategy. This is for investors who have portfolio shares either in futures or in cash. They will do this strategy. But you are going to do bull call spread. Why? Because the margins are also higher here. In your bull call spread, your margins are much lower. Limited profit, limited loss. This is called a collar strategy. Combination of merit put and a covered call. So what do? You offset the premium against the selling of the call. You remember the gentleman Nitin sir? Is Nitin sir there? Nitin sir had given this strategy of Coal India. He had given this strategy in the group. That I've done this strategy, he did not understand that strategy. So the strategy was this: collar. Bought the futures of Coal India, sold the call, bought the put. Limited profits, underline goes up. Limited loss, underline goes down. Am I making sense? Good. Is this clear? So congratulations, friends. We have completed buying cash or one lot futures, selling out of the money call, buying put, 3 leg strategies. Allows you to collect the premium, writing calls, at the same time protection against a sharp drop in the price of underlying. Unlimited profit when underlying goes up, sorry, limited profit underlying goes up, limited loss underlying comes down. Any questions, my friends? Congratulations. Here we are, completed the whole options. So tomorrow we are going to do option adjustments and repairs, strategy matrix, which strategies to use when. Some rules, Max Pain theory. Ramakrishna sir, please avoid strategies where losses are unlimited. My friends, please learn one thing. We are here to make money. Don't make money where you risk your capital. Pavan bhai, bull call spread is always better. Defined risk, Biju sir. Defined risk. I must know whatever strategies I do, this is my maximum loss. When I'm selling a call at 23 rupees, how much can I get? 23. How much can I lose? Unlimited. Why do such trades? Business sense is not there. There's a very nice poem which has inspired me. Don't quit. When things go wrong, as they sometimes will, when the road you are trudging seems all uphill, when the funds are low and the debt are high, you want to smile, you have to sigh. When care is pressing you down a bit, rest if you must, but don't you quit. Life is cruel with its twists and turns, as every one of us sometimes learns. Many a failures has turned about, when they might have won had they stuck it out. Don't give up though the pace seems slow, you may succeed with another blow. Often the goal is nearer than it seems to a faint and a faltering one. Often the struggler has given up when they might have captured the victor's cup, and they learn too late when the night slipped down how close they were to the golden crown. Success is failure turned inside out, the silver tint to the clouds of doubt, and you can never tell how close you are, and it may never be the same when it seems so far. So stick to the task when your heart is hit. It's when you see things are the worst you must not quit. Congratulations, my friends. Here we have Vikesh bhai, do bull call spread, do bear put spread. If you are not sure, do spreads. Shivastav sir, if you have one lot of shares in your portfolio, when you feel ICICI Bank has a resistance, go for a covered call. Vikesh sir, if you want to try, do bull call spread, do bear put spread. It makes more sense. Right? Bull put spread, out of money, far out of the money. Yes, but the risk reward ratio is poor. Right? So the best strategy which gives you the reward and the risk. Right, limited risk. Ramakrishna sir. So I think so all your horizons are opening up now. Earlier when we were in the class, you were confused, but today your horizons are opening up. There are plenty of opportunities. You all agree with that? This is what life is all about. gaining knowledge, gaining experience, and the combination of knowledge and experience takes you to the top. How was your vaccination, Champak Bhai? Hope everything is fine. Great. Good, Somit Bhai. We all are learners. We all learn. You guys have taught me so many new things. Shivastav sir, the guide has already been given. If you see, I've taught you short straddle, I've taught you short strangle, I've taught you long straddle, long strangle. I have given you the bull ratio formula. These stocks where you can do bullish strategies, bull call spread. Everything is in place. Now you have to take. Shivastav sir, there is where you have to jump your journey on your own. I will be there to guide you, provided you have your view. If you tell me to do spoon feeding, I cannot do that. But yes, if you have a strategy, if you know that this is your buy call, this is your strategy, I will tell you go ahead with it. But if you tell me, sir, give me calls, not possible. Ramakrishna sir, you can short straddle and strangle, back test it, you can start. There's no need for paper trade. We have done live trading for a year. I can assure you I have done live trading for a year. Great. Great. So a lot of you are already from TMP. Am I not wrong? So in the TMP, has the golden cash nifty, golden cash strategy been taught to you? Can you do a bull call spread in the golden cash strategy now? Yeah, if you're bullish, you can. So when you have a setup, a bullish setup or a bearish setup, because by lifetime breakout, simple, 2 days, if it sustains above the lifelong high, buy it. Simple, don't wait. For 2 days, if it sustains above the lifetime high, buy it. Really, because by if it's a right breakout, it will not go below the previous lifetime high. If it closes 2 days below the previous lifetime high, that means it's no longer valid. Simple. यहाँ से घुसे अगर वो वापस वहां आ गया, खत्म हो गया. In stock market, the rule is simple. When it's a breakout, it should not come back to the original price after 2 days. Right? So lifetime you keep on trailing, you don't book. Till it is in the bullish zone, you don't book, you keep on trailing. Right? So in the case of options, you cannot trail, so you have to book. So this general thumb rule is 7 to 10% is what you get after lifetime high. Level buy intraday has already been given to you, short straddle, short strangle. So book it and come out, Ramakrishna sir. 6 to 8%. Right? Positional intraday you can do bull call spread, bear put spread. So intraday, short straddle, short strangle, bull call spread, bear put spread. Positional, butterfly, condor. Bhavin bhai discussed. Supposing the current price is 15,900, you feel the upside target is 16,100. So you can either buy a 16,000, 16,000 sell 16,100. So Ramakrishna sir, some will be rewarding, some will not be rewarding. Okay, so Anand sir, stock options, same way, you will only do directional in stock options, right? Only directional. No range bound strategies in stock options. Only bull call spread and bear put spread. Am I clear? Because stocks are trending in nature. They generally trend. So you'll either do a bull call spread or a bear put spread. Right? Good. So that's good for you, Vikesh bhai. If it's trending, let it trend. What is the problem? Don't book. But that does not happen in FNO stocks, Vikesh bhai. Don't compare cash market stocks and FNO stocks. Right? Cash markets are separate. FNO stocks, different movement. Good. So Abhishek sir, now you feel you can be a profitable trader. Is your confidence back? Good. So in life, nothing is impossible. If you have the right knowledge and the right experience, as I told you in the beginning of the class. So Shiv sir, just do the backtesting in 2019 when the VIX was low, it made money. Just do the backtesting in 2019. That time the VIX was lower. Right? Don't worry, VIX will go up from next week. Next week, VIX is going to go up. In August, the VIX will be higher. Don't worry. Right? So now the easy period of the market is getting over. Get ready. All the people doing in cash markets also. Easy period is going to get over. I will not answer anything more. But that easy money that Vikesh bhai said, 35%, 40% in cash market I made, is going to get over very soon. Get ready for it. Right? Everything has a cycle. Easy money cycle is getting over. Now the tough part of the market is going to start. Right? So for an investor, the tough part is going to start from August or July end. It can start from Monday also. So all the best. Hope you guys have enjoyed my session. Right? See you tomorrow for the last session where we are going to do revision. Right? Do your revision. And let us make it happen. Bye-bye. Have a nice lunch. And say thank you to my family for giving me time.